Today, we're diving into one of the most iconic financial disasters in history, the Wall Street crash of 1929. This event didn't just shake Wall Street, it led to the Great Depression, a worldwide economic collapse that would last for over a decade. But what exactly caused the crash, and how did it transform the global economy? Let's break it down. The Roaring Twenties, economic boom and speculation. The 1920s, also known as the Roaring Twenties, was a time of economic prosperity and cultural change in the United States. Technological advances, such as the automobile and radio, fueled the economy. Factories were booming, and consumer culture was on the rise. But this prosperity was not without its problems. The stock market saw explosive growth, with millions of Americans investing in stocks, often with borrowed money. Speculation was rampant, and many people believed the market could only go up, which created a bubble waiting to burst. The stock market bubble and the role of margin buying. Much of the speculation was driven by a risky practice called margin buying. This allowed investors to borrow money from brokers to buy stocks, often with as little as 10% of the stock's value as a down payment. For example, if you wanted to buy $1,000 worth of stock, you could borrow $900 and only need to pay $100 up front. This created an artificial demand for stocks, driving prices higher and higher, regardless of the company's actual value. But this also meant that when stock prices started to fall, investors were left owing far more money than their stocks were worth. The initial warning signs, September 1929. By September 1929, cracks began to appear in the stock market. The first signs of a downturn came when stock prices began to fall, and some investors started selling off their stocks. But the panic didn't set in immediately. Many believed the market would quickly recover, as it had in the past. However, the warning signs were clear. Investors were over-leveraged, and the stock market had become too volatile. The crash begins, October 24, 1929, Black Thursday. The crash officially began on October 24, 1929, a day now known as Black Thursday. On that day, stock prices plummeted, and panic set in. Investors rushed to sell their stocks, and as more and more people tried to sell, the value of stocks collapsed. By the end of the day, the market had lost over $11 billion in value, equivalent to nearly $200 billion today. The aftermath, Black Monday and Black Tuesday. The panic deepened in the following days. On October 28 and October 29, known as Black Monday and Black Tuesday, the market continued to fall sharply. Stock prices plummeted by another $30 billion, wiping out the savings of countless families. By the end of the week, the stock market had lost almost 90% of its value from its peak just a few months earlier. People who had bought stocks on margin were left with massive debts they couldn't repay. The crash devastated the financial system, and banks that had invested heavily in the market failed as well. The Great Depression. The Wall Street crash of 1929 didn't just affect the stock market. It triggered the Great Depression, a decade-long economic disaster that affected countries around the world. As businesses collapsed and banks failed, unemployment soared. By 1933, nearly 25% of Americans were unemployed, and millions were living in poverty. The crash had turned the booming 1920s into a devastating economic struggle for millions of people. Government response. The New Deal. In response to the economic catastrophe, the U.S. government, under President Franklin D. Roosevelt, enacted the New Deal in the 1930s. The New Deal introduced sweeping reforms, including Social Security, labor rights protections, and banking regulations. One of the key reforms was the creation of the Federal Deposit Insurance Corporation, FDIC, which insured bank deposits to restore public confidence in the financial system. The New Deal marked a new era of government intervention in the economy, aimed at preventing future crises like the Wall Street crash. Legacy of the Wall Street crash of 1929. The Wall Street crash of 1929 and the Great Depression had a lasting impact on the U.S. financial system. It showed the dangers of unchecked speculation, and the government responded with stronger financial regulations and social safety nets. The creation of the Securities and Exchange Commission, SEC, and the Federal Reserve's expanded role in the economy were key steps in preventing future crashes. Today, the lessons from 1929 continue to guide financial markets, ensuring that systems are in place to prevent a repeat of such a catastrophic event. The Wall Street crash of 1929 remains one of the most devastating financial events in history. It taught us the importance of financial regulation, the dangers of speculation, and the need for government intervention during times of crisis. What do you think? How do you think the lessons of 1929 apply to the world's financial markets today? Let us know your thoughts in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more in-depth looks at financial history. Thanks for watching, and we'll see you in the next video.